You're a high income earner and you're paying a lot of money in taxes. Right now, you make too much money to contribute to a Roth IRA. Therefore, you're maxing out your 401k in order to bring the tax bill down while you save for retirement. What if there was a way to get money into your Roth IRA even though you make too much money to be eligible to contribute? Well, there is. It's called the Mega Backdoor Roth IRA strategy, and I'm going to show you how it works. I'm Brad Lineberger, certified financial planner and founder of Seaside Wealth Management, and I'm here to help you create peace around the issue of money, both now and in retirement. I'm passionate about coaching people on the topic of finances, and that's why I create these videos. In this video, we'll go over all the benefits of the Mega Backdoor Roth strategy and how it can affect you and your family. In order for me to coach you on the strategy, I'm going to introduce you to two people who might be really similar to you, Tom and Kim Truman. Tom and Kim are clients of mine, and of course we've changed the name for confidentiality purposes, but Tom is 55 years old. He's a Qualcomm executive earning about $267,000 a year. He's been maxing out his 401k for years, and he receives a nice match on the 401k. He's also taking advantage of the catch-up contribution since he's over the age of 50. He's got RSUs, or restricted stock units, that he's been selling and investing into a taxable account. Kim is 52 years of age. She's a stay-at-home mom, and she's involved in the local church. She's a high school group leader. They live in San Diego, where the Trumans bought a home in 2009 at a great price, right around $1.1 million. The home is now worth $2.5 million. Tom's not been able to contribute to his Roth IRA for years due to the income limits. His goal is to be able to grow an account that's tax-free, so that way he can ultimately pass it on to the kids and build multi-generational wealth. He's in a men's group at church, and all of the high net worth individuals are talking about their Roth IRAs. But as a high income earner, Tom's confused. He doesn't understand how these guys are getting money into their Roth IRAs, especially when they make as much as he does. So he wants to know, how does he do this? He reached out to me and he was asking, how are these guys making contributions? I know they're making more money than me, and I'm not eligible because of income limitations. And that's when I explained the Mega Backdoor Roth IRA strategy to Tom, and he loved it. Let me show you how it works. Tom is currently maxing out his 401k at $23,000 per year on a pre-tax basis. He's doing the catch-up contribution at $7,500, and then Qualcomm's giving him another $8,000 on his 401k as a match. Because of Tom's income, he's not able to make those Roth IRA contributions. Now there's some key components to the strategy, and we're going to cover those later, but first let me tell you the details of how this thing works. The actual maximum contribution into a 401k is $69,000. This is another $30,500 beyond how much Tom is contributing plus the match. And so in order to explain how this works, I'm going to show you, I've got these three buckets over here. So this is what Tom is doing. He's putting money into the traditional 401k, which is lowering his tax bill in the year that he makes the contribution, so that's good. But the challenge that Tom is gonna have in the future, and as we're doing multi-year tax projections for him, he's seeing what he's gonna run up against, is that all of the money that's building on a pre-tax basis is ultimately gonna be forced to come out of there in the form of required minimum distributions, which for Tom are gonna start at age 75. And every dollar coming out of that 401k is taxed at ordinary income rates. So whether Tom knows it or not, he actually has a business partner on that 401k. It's the IRS. And the IRS is actually rooting for that account to grow because every dollar coming out is taxed at ordinary income and they get to generate a lot of revenue. So in most 401k plans these days, there tends to be a Roth component. So how the Roth component works is, regardless of income amounts, you can make contributions to your Roth 401k. Now you do not get a tax deduction for making contributions. So that's the main difference in a Roth 401k to a traditional or pre-tax. So you don't get a tax deduction for making the contribution to the Roth, but the benefit is all of the money grows completely tax-free. And that's why people like this. But in the case of Tom and Kim, the challenge they're running into is they need the deduction because they're paying too much in taxes. So that's why they've chosen to go pre-tax. However, as I mentioned, a lot of 401k plans out there have a third bucket, which is the after-tax 401k component. So this is a key. You want to make sure that your 401k plan offers this, and if it does, here's how you utilize the rules to take full advantage of this. After maxing out your 401k plus the match, you can get a whole lot more money into the 401k account, and where it goes into is this third bucket known as the after-tax 401k. This is really the least talked about bucket, and it's really not that exciting unless you know the rules and how to use them to your advantage. So I'm going to show you. What you do is you make a contribution to the after-tax 401k. Under normal circumstances, that money grows, and when you retire or when you change jobs, the earnings, the gains on the account have to come out and they're taxable, just like on a traditional 401k. So you're sitting there scratching your head going, well, what's the benefit of an after-tax 401k? Why would you even want to do this? The benefit of the after-tax 401k is that a lot of 401k plans that I see allow you to make contributions to the after-tax 401k and then immediately do in-plan conversions to the Roth 401k. So let me say that again. You make the contribution to the after-tax 401k, and then you immediately do an in-plan conversion. And because there was no tax deduction on the contribution to the after-tax 401k here, therefore, there's no tax consequences to convert into the Roth 401k. Now, why would you want to do this? The reason why you want to convert immediately is because all of the growth in that Roth 401k is tax-free. So if the growth happens in the Roth bucket and not the after-tax bucket, now you get the benefits of having all the growth happen in the tax-free bucket. And that's the beauty of the strategy. And so if you do this consistently for years, you can get an extra $30,000 a year into this tax-free bucket that you otherwise couldn't have done. So when you retire, you're going to take any dollars that are in a Roth 401k bucket, you're going to roll that directly to a Roth IRA, and then you're going to take your dollars that are in the traditional 401k bucket, and you're going to roll those dollars to a traditional IRA. Now, what happens in the situation where your after-tax 401k doesn't have the ability to let you do in-plan conversions? Let's talk about that situation. So what happens if that after-tax component is going to have two parts to it? It's going to have the money that you contributed, and then it's going to have the growth that's been attained. And so how this works at retirement or when you leave your employer, all of the contributions into the after-tax, those can roll into a Roth IRA. So that's the good news, is those contributions can then roll into a nice tax-free bucket. But the growth or the earnings in the after-tax 401k, that should roll into a traditional IRA. So it's not all bad news if your plan doesn't allow in-plan conversions on the after-tax. It just means you can get those contributions ultimately to go into a Roth IRA. The growth just can't. Although that can set you up for a situation where you retire and then you get into what we call the gap years, which are those years between when you retire and when required minimum distributions kick on, which is either age 73 or in the year 2033, it's going to become age 75. So those gap years, we like to assess whether it makes sense to do Roth conversions in the gap years. So in this example here, if you weren't able to get all of your after-tax 401k into a Roth, but had to roll some to a traditional IRA at retirement, that's okay, because during the gap years, we're going to assess when we can get you down into a lower bracket. That's when we like to do those conversions. Now the key, folks, you got to make sure that in the years preceding retirement, say 5, maybe even 10 years before, you want to start building your cash buckets, because that's the money. The cash is what you're going to live on during your gap years. as you do Roth conversions and start to shift money out of that pre-tax bucket, which ultimately is going to have large required minimum distributions. And you're going to find that your tax bill in the future is going to be your largest expense in retirement. Second largest expense is going to be healthcare expenses, but the tax bill is going to be number one. And the way to alleviate that is taking advantage of strategies like this, getting the Mega Backdoor Roth, getting as much money into Roth IRAs legally through legal channels just by knowing the rules and using them to your advantage. So I know that this is somewhat of a complex strategy, but if this makes sense for you, if your 401k plan meets the criteria and you have the cash flow to be able to do this, this strategy is a home run strategy when and where it makes sense. I love to watch this unfold because I see people literally save hundreds and hundreds of thousands of dollars on taxes by simply knowing the rules and taking advantage of them. When the front door to making Roth IRA contributions is locked, go through the back door. In this case, go through the Mega Backdoor and get as much money into tax-free buckets as possible using legal loopholes. If this strategy resonates with you or you have questions about it, please get in touch with our team and we'll help you plan a strategy to get as much money into tax-free buckets as possible. There's a lot of advice out there on this strategy, but you don't want to DIY it. The mistakes can be very consequential. So work with the professional, get the professional guidance that you need, and get in touch with us now.